Welcome, everybody. I hope every one of you is doing well. Today, I am going to illustrate how to build the three financial statements, which are the income statement, the balance sheet, and the cash flow statement for a simple business. And we are going over this to help you prepare for the final exam. In today's example, we're going to open an ice cream business, and we are given a scenario which describes what happens in the first week of business. Okay, so here you can see the scenario for our ice cream business, and we're also going to assume an accounting period of 1 week. During today's lecture, we are going to walk through the scenario line by line and determine how each individual transaction affects the income statement, the balance sheet, and the cash flow statement. And before we get started, I have a few recommendations for you. First, I recommend that you print out the business scenario that you see on my screen. This will help you remember which particular transaction we are working on when the screen is projecting the financial statements instead of the scenario. Second, I recommend that you also print the financial statements so that as we walk through this together, you can try to modify the financial statements first yourself before you listen to the solution. This will help you prepare for the final exam, where you will be given a similar scenario. So you can simply pause the video before I cover how each transaction affects the financial statements. You can find all this information on Blackboard. So here we have the announcements for the course, and there is an announcement that was posted on Wednesday, April 8th, that is titled Practice Financial Statements Uploaded for Final Exam Review. In this announcement, you can find a link to a document that includes the scenario and the financial statements. So if I click on this link here, it will open up a Word document that looks like this, where you have the business scenario that's identical to what we will cover today during this lecture, as well as the templates for the financial statements. And of course, you will have these templates as well for the final exam. The same announcement also has a link to the lectures on YouTube that cover the financial statements, which you might want to look at if you feel you still struggle with building the financial statements after this review. Of course, feel free to email me as well with any questions or concerns you may have. Okay, so back to our scenario. The first transaction that we see here says you invest $5 in your ice cream selling business. How is that going to affect our financial statements? So I'm going to pull up the financial statements now. The first financial statement that we should look at is the balance sheet. So remember, the transaction was you invest $5 in your ice cream selling business. How is that going to affect the balance sheet? The first thing that's going to happen is you're going to get $5 in cash, which is wonderful because you will need cash to run your business. Also, owner's equity is going to increase with $5 under original investment. For the income statement, we always ask ourselves, does this transaction represent sales or any costs related to producing the ice cream we are selling, or any other costs related to being in business referred to as expenses, right? Does it have anything to do with sales, cost of goods sold, or expenses? And if the answer to all those questions is no, the transaction does not affect the income statement. In this case, our $5 original investment does not come from selling ice cream, has not yet been used to purchase inventory or pay for production labor, and has not been used to pay for any other business expense. Hence, this transaction does not affect the income statement. Moving on to the cash flow statement. Does our transaction of our $5 original investment in our ice cream business affect the cash flow statement? The question you should always ask yourself for the cash flow statement is, did any cash come into or leave the business? In this case, since we used $5 from our piggy bank to invest in our company, there is now $5 in cash available to the company that wasn't available before. And in this case, we are just going to put that under beginning cash. So you would have 5 under beginning cash. Going back to our business scenario, the second transaction is that you get a $25 loan from the bank. How does that affect the balance sheet? The first thing that would happen is our cash would go up. Instead of having $5 in cash, we now have 5 plus $25 from the loan from the bank, a total of $30 in cash. However, we also now have a liability. We have to pay this loan to the bank back. The $25 is not really ours. So the $25 would also go under liabilities and under notes payable in this case. You can see that we are still in balance because our assets column has a total of 30 and our total liabilities and owner's equity that would go over here is also 30, meaning 25 from notes payable and $5 from the original investment. Does the $25 loan from the bank affect our income statement? Remember the 3 questions that we have to ask ourselves. Does the $25 come from sales of ice cream? No. Did we use the $25 to purchase inventory or to pay for production labor? No. Did we use the $25 for any other business expenses? No. So in this case, the $25 loan from the bank at this point in time does not affect the income statement. How does a $25 loan affect the cash flow statement? The question we have to ask ourselves for the cash flow statement is, do we see any cash inflows or outflows due to the transaction? We are getting $25 from the bank as a loan, but it is effectively $25 in cash that we can now use in the business. So we have a $25 cash inflow from this loan. And this would be reflected under the financing cash flow, specifically under borrow payback. So we would write here plus 25 from the bank loan. And we are going to use a plus to indicate a cash inflow. And we're also going to mention here where this money comes from. It is important that you itemize the transactions on the cash flow statement because I will want to see where this $25 came from and that you understand that. And so for the final exam, this is something that I take into account for grading. If you do not itemize your transactions, you will get less credit or no credit for your answers. Back to the business scenario. Our third transaction involves us going to the grocery store and paying for our ingredients. So you go to the grocery store and you buy half and half, heavy cream, eggs, vanilla sugar, and vanilla extract. And you buy enough to make 40 scoops of ice cream. Your total cost is $20. And the way you pay for this is you use $10 in cash and $10 is charged to your account at the grocer. This means that you don't pay cash today, but you will have to pay the grocer at some point in time for the $10 of ingredients that you have received. So let's see how this transaction affects the financial statements. So remember that we went to the grocery store and we purchased $20 worth of ingredients, $10 we paid cash, and $10 was charged to our account at the grocer. So first, we should see if anything in our assets column goes up. And yes, we now have $20 worth of inventory. Okay, you don't write 40 scoops, you write a dollar amount. So you would write $20 here worth of raw materials in our inventory. We use $10 in cash. So cash goes from 30 to 20, cash goes down 10. And we also owe the grocer $10 for ingredients that we have received but have not yet paid for, right? So we have an accounts payable balance of $10 as well. And so if we write here 20 for the ingredients, for the total ingredients, we can see that our total assets are at 40 and our total liabilities right now are at 35. Our total owner's equity is at 5, which means that total liabilities and owner's equity is at 40. and this means that we are in balance. Next, let's look at how this transaction affects the income statement. Remember, we bought $20 worth of ingredients, $10 we paid in cash, and $10 was charged to our account at the grocer. So this is the first transaction that will actually affect the income statement here under purchases. Okay, so we have $20 in purchases. The income statement doesn't care whether these purchases were done in cash or whether they were charged to your account at the grocer. This income statement follows the accrual method of accounting, not the cash method of accounting. So we have added the full $20 that we spent to purchase our ingredients on the income statement. We can also complete the box for beginning inventory. At the start of the week, we didn't even have a business, so our beginning inventory this week was 0. Back to the cash flow statement. The question for the cash flow statement is, did any cash come into or leave the business? When we went to the grocer, we purchased ingredients worth $20. We paid $10 in cash and $10 was charged to our account at the grocer. So on the cash flow statement, you wouldn't see $20 for inventory paid, but only $10 for the part of the inventory that we paid in cash. So we're going to write here under operating cash flow minus $10. You could use grocer or ingredients or any word that signals to me that you understand where this $10 went. And we use minus $10 because this is a cash outflow. Back to our business scenario. The next line is, your brother makes a batch of ice cream for 20 scoops and charges $1 for production labor. So let's take a look at how this affects the financial statements. And please note, it says here specifically that you use cash to pay your brother for production labor. So we're back at the balance sheet here, and we have paid our brother $1 in cash for production labor. This can be a little bit confusing to students, but basically the $1 in production labor is going to increase the value of our inventory. The value of the production labor is tied up in the inventory. So one thing that is tricky here is that you have to notice that your brother only uses the ingredients for 20 scoops, okay? He's only going to make 20 scoops. However, your ingredients are enough to produce 40 scoops. So your brother is only using half of your raw materials to produce this batch of ice cream for 20 scoops. So going to the balance sheet, okay, the first thing that we're going to do is we're going to say, okay, he used ingredients for 20 scoops, but we had ingredients for 40 scoops. So he's using half of the raw materials. The raw materials go from 20 to 10, and our finished goods, which means our 20 scoops of ice cream, are also worth $10. Now we still have the matter of the $1 of production labor that your brother charged you in cash. The value of your brother's production labor is tied up into the finished goods. If your brother had not spent time producing the scoops, you would not have had them. So this $1 that you paid your brother in production labor is going to increase the value of your finished goods. The finished goods are worth $10 in ingredients plus $1 in labor, and that would add up to 11. The value of your total inventory of raw materials and finished goods is 21, okay? And we can see that if we now would calculate our total assets, we would be at 41 and we're not in balance. We have forgotten to take our $1 in cash. So cash is going down from 20 to 19 to pay our brother, and our total assets are at 40. Your brother's labor to produce the ice cream is also going to go here where you see labor. So you would get $1 here for production labor to produce your goods. So we had $20 in ingredients and $1 in labor, which gives us a total available for sale worth of $21. Going to our cash flow statement, we should ask ourselves, did any cash leave or come into the business? Yes, we used $1 in cash to pay our brother. And because this $1 in cash increased the value of inventory, it would go under inventory paid. So we would get minus $1, labor or brother or anything like that. Okay, the next thing we're going to do is exciting because we can finally sell our ice cream. And you sell the 20 scoops, which is all the scoops that your brother made, at $1 each. You receive cash for 10 scoops and the other 10 scoops are purchased on account. So total sales of 20 scoops at $1, total sales worth $20. You get cash for 10 scoops and the other 10 scoops are purchased on account. So remember, we had $20 in sales, $10 that we are going to receive in cash, and $10 purchased on account. So our cash goes up by $10 from 19 to 29. And we sold another $10 worth of ice cream, but we have not received the cash for that yet. However, this is considered an asset because people owe you this money and it will go under accounts receivable. Okay, so you have $10 worth of accounts receivable of ice cream that you sold, but for which you have not yet received the cash. The other thing that's affected is our inventory. Our finished goods goes down to 0 because we sold all the 20 scoops that our brother had made. So finished goods goes from 11 to 0 and inventory goes to 10 because you only have $10 left in raw materials. This brings our total assets to 49. So note that we are not in balance here. So we have to change something here under liabilities and owner's equity. And the thing is, when we sold this ice cream, we made money. We made a profit, okay? We made some earnings. And so that has to be reflected because that increases the owner's equity in the business. When you think about it, we know that we received $20 for the 20 scoops. We sold them at $1 each, 20 scoops at $1 each. So we got $20 in sales. We also know that it cost us $11 to make those 20 scoops of ice cream, $10 to pay for the ingredients, and $1 to pay for the production labor. So our gross profit, okay, or earnings so far are $20 in sales minus $11 in finished goods, which is earnings week to date of 9. So we would fill that out here under owner's equity, and that will bring our total liabilities and owner's equity to 49, and it will bring us back in balance. For the income statement, remember the 3 questions we have to ask ourselves. Does it have anything to do with sales? Does it have anything to do with cost of goods sold? And does it have anything to do with other business expenses? Definitely, we made sales, right? And how much did we make in sales? $20 because we sold 20 scoops at $1 each. And for the income statement, it doesn't matter whether this was in cash or not in cash. So we have sales of $20. We also know that the 20 scoops cost us $11 to make, $10 in ingredients, and $1 in production labor. So our cost of goods sold, okay, was $11. And this brings our gross profit to 9. Also, our ending inventory is 10 because we had 21 available for sale minus our ending inventory of 10 gives us our cost of goods sold of 11. And you could go back to the balance sheet and you can see, yes, we have 10 in inventory, right? We have 10 in inventory. That's just $10 here. Okay, so for the cash flow statement, we ask ourselves, did any cash come into or leave the business? Do we have any cash inflows or outflows? And in this case, yes, we sold 20 scoops at $1 each. Now, don't write $20 under collections because you only received cash for 10 scoops. So under collection, we would write plus $10 from sales in cash. Our next transaction is that we are going to repay $10 of the bank loan. How does repaying $10 of the bank loan affect our balance sheet? Well, if we have to repay $10, that means our cash would go down by 10. So cash is going to go from 29 to 19, and it brings our assets to 39. It also brings down our liability with the bank. Our notes payable, reflecting the $25 loan we had with the bank, now goes down to 15 because we paid back $10 of this loan. That brings our total liabilities to 25. Owner's equity stays at 14, and this brings our total liabilities and owner's equity to 39. And yes, we are in balance. Going to the income statement, we ask ourselves, does paying back $10 of the bank loan have anything to do with our sales, our cost of goods sold, or our expenses? No, right? The $10 we just gave you back had nothing to do with selling ice cream, nothing to do with producing ice cream, and we didn't have any expense related to repaying the $10 of the loan. What about the cash flow statement? The cash flow statement is affected also because we used $10 in cash to repay the bank loan. So under financing cash flow, borrow payback, we have a cash outflow of $10, okay, for paying back the loan. We thought there was no expense related to the bank loan, but actually the banker decided to charge us $1 in interest, and we have to pay that interest using cash. So let's see how it affects our three financial statements. When we have to pay $1 in interest in cash, this would reduce our cash from 19 to 18. And that brings our total assets to 38. So we are not in balance right now. The other thing that is affected by having to pay interest is our earnings, right? Our profits, what we have left at the end of the week in our pocket. So our earnings week to date is going to go from 9 to 8. And this is something that you have to remember, is that expenses, such as an interest expense, affect the balance sheet through earnings week to date. So our earnings week to date was reduced by 1, and this brings our total owner's equity to 13 and our total liabilities and owner's equity to 38. For the income statement, we ask ourselves, does the transaction have anything to do with sales, cost of goods sold, or other expenses of being in business? And the answer here is yes, because the interest that you pay is an expense of being in business related to having that bank loan. If you hadn't been in business, you wouldn't have had this expense. So we're going to add an expense here for the bank loan, okay, for the interest expense. The expense is $1. Going to the cash flow statement, we know that we paid for this interest in cash, so it's going to affect our cash flow statement. And more specifically, it affects our operating cash flow. Okay, there is a separate section here for interest paid. You do not have to itemize that because it already says it's for interest, but just to be sure, you could always just do that. The next line in our business scenario demonstrates that we're a little bit the victim of our own success. Our neighbors, where we have our ice cream stand, they ask us to buy an insurance policy because, your business has been kind of busy and they're worried about it. The insurance agent offers you a 3-week policy, which costs $3 payable in advance. And you have to pay for the entire policy in cash now, but you will use it over the next 3 weeks. And remember, our accounting period is 1 week. So we're going to use only $1 of this insurance, this week's insurance, during this accounting period. And we will have $2 left that we're going to use in future accounting periods. So let's see how that affects our financial statements. In terms of the balance sheet, we know that we have to pay for this insurance policy right now in cash and for the full amount. So the insurance policy costs $3 and we have to pay in cash. So cash goes from 18 to 15. We also know that we're not using the full value of this insurance policy this week, this accounting period. We will be using $1 this week, and we will still have $2 left of this insurance to use for the next two accounting periods. So basically, we have an asset of a prepaid insurance. And so this would go under prepaid expense, and the value of that prepaid expense is $2. You've used $1 of the $3 insurance this week, and you will use $1 next week and $1 the week after. So you have $2 left for future accounting periods. This then brings our total assets to 37 because we spent $3 in cash, but we still have $2 worth of insurance on the books. We're not in balance. Do you remember how expenses affect the balance sheet? Expenses affect the balance sheet through earnings week to date. The fact that we have these business expenses reduces our earnings. So our earnings week to date go from 8 to 7, right? Because this week we are using $1 worth of insurance. And that brings our total owner's equity to 12 and our total liabilities and owner's equity to 37. How does this insurance purchase affect the income statement? Does it have anything to do with sales? No. Does it have anything to do with cost of goods sold? No. Does it have anything to do with other expenses related to being in business? Yes, right? If you hadn't been in business, you would not have needed this insurance. And this week, we used $1 worth of insurance. So you would have an insurance expense here for $1 during this accounting period. How does the insurance expense affect our cash flow statement? And the question there is really, how much cash did you spend on it this accounting period? And so remember that you had to pay the entire policy in cash now. So you had to pay $3 in cash right away. The insurance expense would go under operating cash flow under this category called SG&A paid, which stands for selling, general, and administrative expenses paid. So here we see a cash outflow, so it would be a minus of $3. You had to pay $3 in cash this accounting period for the insurance. We're almost there. In your next line, you purchase a fixed asset. You purchase an ice cream stand for $8 and also a tiny patch of land from a friend's family for $2. You pay for the stand and the land with cash, so $8 and $2 that you pay for with cash. You depreciate the ice cream stand $1 per week, including during your first week of business. So we're starting to depreciate this ice cream stand this accounting period. Okay, so let's see how the purchase of this fixed asset as well as the depreciation affect our balance sheet. So we purchased a fixed asset worth $10, okay? However, we are already depreciating it by $1 this week. So our book value of this fixed asset is going to be $10 minus $1 in depreciation would be $9. That's how much this fixed asset is still worth on the books. So we would have our original acquisition cost of $10. We are depreciating by $1 per week, including this accounting period. So on the books, our fixed asset is worth $9 at this point in time. Remember that we paid for the ice cream stand and the land using our cash. And we spent $10 in total purchasing these. So our cash goes from 15 to 5. So now our new total assets, 36. Note that we are not in balance. Our total assets are not equal to our total liabilities and owner's equity. Remember that we said that expenses affect the balance sheet through earnings week to date. And the expense that we're facing here is the depreciation expense. So we had a depreciation expense of $1 that is going to reduce our earnings for this week. So we bring earnings week to date to $6. And that would bring total liabilities and owner's equity to 36, and it would bring us back in balance. How Does the purchase of the fixed asset and the depreciation expense affect our income statement? Does it have anything to do with sales? No, not at this point in time. Did you purchase any ingredients or pay for production labor? No, we purchased an ice cream stand and land and depreciated it. And is there any business expense related to the last transaction? And here we would have to say yes, because we have a depreciation expense. Depreciation expense is only an expense that happens on paper, on financial statements, right? So we're going to add a depreciation expense here of $1. And that brings our total expenses to $3. And it gives us a net profit of, or gross profit of $9 minus $3 in expenses, which adds up to $6. Going to our cash flow statement, okay? You know that you purchased an ice cream stand for $8 and land for $2, and that you paid with cash. So this would be going under investing cash flow. And we basically had $10 that we spent on the stand and the land, okay? And it's a cash outflow of $10. It's money that left the business. Then we also had the $1 depreciation expense. Where would you put that? Well, the depreciation expense is not a cash expense, so it would not show up on the cash flow statement. Okay, so now we are at our last transaction. A customer pays $4 for 4 scoops she bought on account. So you had already sold those 4 scoops, but the cash hadn't settled. But this customer is now ready to pay you $4 in cash. So the customer pays you $4 for scoops that you had sold already. Your cash goes up by 4, okay, to 9. What else changes? Does earnings week to date go up? No, it doesn't go up because you accounted for the sale in the beginning. The thing that goes down is accounts receivable, because here are the $10 that you still had to receive from customers that had already received the ice cream. So accounts receivable goes from 10 to 6. And basically nothing really changes other than that. Our total assets stay at 36. We basically just had a switch in the asset column from accounts receivable, $4 that went to cash. Does anything happen to the income statement? Does the fact that this customer pays you now $4 for 4 scoops that they had bought an account change anything to sales? You had already accounted for those sales here in the beginning of the week, where you did not distinguish between whether you received cash for the ice cream or whether the customer bought the ice cream on account. So nothing really changes to the income statement. Since there is a cash transaction involved here, there would be a change on the cash flow statement. And basically, it would go under collections because you receive money from sales. You receive $4 here, and it comes from accounts receivable. Okay, so now we can finish the cash flow statement. We have plus 14 here. We have minus 11 here, minus 3, and minus $1 in interest. That brings us to negative operating cash flow of minus 1. We also had fixed asset investment of minus 10, so we have negative investing cash flow of minus 10. And we had financing cash flow through the bank loan, and that was a positive cash flow of 15 under borrow payback, and that brings us to a positive total financing cash flow of 15. Remember that we had $5 in beginning cash. This is the original investment that we did in our business, and our change in cash is minus 1, minus 10, plus 15. So you would have a change in cash of $4, and that would bring our ending cash to 9. There's a few checks and balances that we can do. First of all, this ending cash here on the cash flow statement needs to be the same as the ending cash on your balance sheet. The other thing that has to be the same is your earnings week to date has to be the same as your net profit on the income statement, right? Because the earnings week to date, if you blow that up and you want to listen to the story of how you got to those earnings week to date, you would look at the income statement. Okay, so that's it. We filled out these 3 financial statements and it seems like they make sense. That's what you can expect also for the final exam. You would get a different scenario. There will be multiple scenarios, especially since this is a take-home exam now. And please, if you have any other questions about this, feel free to reach out to me. You can also look at the online lectures, but of course, I'm available for any questions that you may have regarding this. Good luck and talk to you soon. Bye bye.